Welcome back to another week of the Educated Homebuyer Live, where Josh and I answer your mortgage and real estate questions live to help you guys become the educated homebuyer. So since last week, we've got some data. The most important news that came out was the Fed coming out today, more or less keeping that's with regards to, the Fed funds rate, which is exactly what the market had predicted. But the market also predicted that the Fed would become a little bit more hawkish, and Powell didn't really change his stance, which is a good thing. The market reacted in a positive way. But Josh, as you know, we still got a big report on Friday. So welcome to the show.
Yeah, no, Fed Day is always fun, trying to parse what the market expected, what the market got, what the Fed speak actually means. Powell is a little more direct than Bernanke was pretty direct. I don't even know how long we had. What's our Treasury Secretary? What's her name? Yellen. We didn't have her all that long, but and Greenspan was just the worst. Like he could give you an hour-long speech and sound really smart, and then you would go back and look and go, what did he actually say? Powell's pretty straightforward, and we have some comments here that we're going to go through that gives you a pretty good feel with where he's coming from. And I will go so far as to say you are 100% correct that the market was worried or expecting some hawkish comments from him, but it wasn't just neutral. He was a little bit to the dovish side, not much, but a little bit, definitely relative to expectations.
Yeah, and the episode is, titled "Higher Interest Rates Are Here to Stay." So we're going to talk about that in a little bit more detail as we dive into some of the charts, answer your questions, again, to help you guys become educated home buyers. So Josh, let's do as we always do here and start with some charts. And holy cow, what did you do to me here?
I just ran all the way. Do you want to just start with the Fed stuff so we can get it out of the way before you go into
you're changing everything that we always do. You're changing everything, Josh.
We can go back.
Tradition. You're killing tradition.
You're uncomfortable with it. We'll go back to slide number one.
Go back.
I got it. No, we're over. I'm back. We're back at slide number one. So the Jed
look at that.
Can stay in his comfort zone.
Look at that. Josh was not confident in the way he wanted to start. All I had to do was say it was out of tradition. He broke, came back to where we start. So as we always do, we start with inventory because inventory tells the story. Right now, inventory is continuing to increase. We're seeing, saw about 16,000 or so new homes come to the market this past week. Currently sitting at, Josh, where are we sitting? We're sitting at 556,000 homes nationwide, which is the highest level that we've seen in, since November of last year, I believe is where we are. So we're up about 30% year over year, which is kind of in line with where we've been. Orange County sitting at 2290, Huntington Beach sitting at 135. These are numbers that we look at every single week. But what we decided to do is throw in some charts because we've been keeping track of this data. And we thought it would be interesting to kind of see what the numbers actually look like going back to when we started keeping track of these numbers. So as you can see in Orange County, active listings are up. You can kind of see that steady climb, but we're not back above where we were in, what's that, Josh, October of 2023. So we're still below the highest levels that we saw in last year. But if rates continue to stay high, inventory is likely to continue growing, and you're going to see these numbers climb above the 2023 numbers. Huntington Beach is a little bit more interesting because Huntington Beach, we're still sitting at levels that we haven't seen since the early part. Not even. I mean, I think the number was today we're sitting around 135. I think the lowest level that we saw any time in 2023 was 132. So we're pretty much at the bottom of what we saw all of last year. In fact, last week when we were sitting at 129, we were at the lowest level that we had been in almost 2 years. So inventory is growing, but it's not in a crazy pace.
The interesting thing about Huntington to me is, if you guys are out of the area, it won't mean anything to you. Huntington Beach is one of the cheaper beach cities in Huntington Beach, or in Orange County, but it is not a cheap city. So if I'm looking at this, we know what is super hot is the most affordable entry-level stuff. I would expect to see Anaheim, Santa Ana, Garden Grove struggling with lower listings because they're a little more affordable and you have all the demand sitting in that space. Huntington has a lot, but really nothing under $1 million, which is where most of the buyer activity is right now. So that's a little surprising to me.
Yeah. And as we talked about, Josh, today in the podcast, what you're seeing is kind of the higher price points is what's pulling inventory up, but it's not what people are buying. So that's why you're seeing inventory grow a little bit, because it's not at or under that median home price, which is where the majority of buyers are.
But more importantly, what you just said, Jeb, the more important piece of that is it's why a lot of markets, most markets, entry-level buyers are not feeling, they're like, I'm not feeling any more inventory. I'm not seeing more homes available to me, because it's generally growing at the higher price points. Do you maybe want to touch on, Jeb, that Housing Wire article where they went through the numbers of how Texas and Florida are impacting the national discussion and maybe giving people a false impression of what's happening inventory wise in their markets?
Let's tie it up at the end, get through these charts, and that way we can kind of get back in. But yeah, I think it's important, because that is what people need to know. Weekly inventory, as we said, rose from 543 to 556 week over week. We're still below that peak of 2023, which was 569,000. And if you take us all the way back to 2015, we're about half of where we were active listing wise at that time. New listings, Josh, I actually forgot to pull up my information here, so bear with me for a moment, and I'll pull it up and we'll talk about new listings. Maybe not. I don't, I'm typing with one hand over here, and it's my left, and
you got to get one of those one-handed.
It leaves a lot. It leaves a lot to the imagination. In fact, I might not have even updated the weekly. I did not. So basically, weekly new listings sitting at just over 70,000 new listings. As you can see, new listings are continuing to climb. Exactly what the chart is showing. Total home sales contract, total home sales contracts pending. What do we have, Josh, there? I can't read the chart, but 398 homes in contract. It's up, 6% more than last year. So again, continuing to grow. Median price of homes in contract also continuing to grow, just up a little bit over this point where we were last year. And then percentage of properties with price reduction now sitting at 32%. So we were at 30%, 30.4 or 32.4%. Climbed just a little bit, starting to tick back up a little bit. And you're going to see that as inventory, grows. As it moves sideways, if sellers need to sell, they're going to need to do something to entice buyers, and price reductions is the first thing that most buyers or most sellers consider.
So this week, Jeb, we had 3 of the indices published for the most recent 30 days. Case-Shiller National Index up 0.41 month over month, 6.4 year over year. FHFA up 1.2% month over month, 7% year over year. Freddie Mac 0.39% month over month, 6.6% year over year. So pick your measure, plus or minus 6.5%, 7% year over year. We are starting to see that pop of the spring buying season. We've talked about, and we did an episode, a month or so ago, about the seasonality, where this is the time of year where you're going to see most of it. So the month over month is going to be bigger. It will have an impact on that year over year, but the year over year has 12 months covered in it. So I don't expect that we will see that number. Is that number surprising to you, Jeb? We talk about the long term 40, 50-year average being at 4.5% nationally. When I see a number north of that after the 2 years that we had during COVID, it just shocks me. Very unexpected.
No, agreed. I mean, if you take us back to 2022, Josh, we started 2022 and we were saying, how can you duplicate what we just saw over the last year? And then the first 3 months of the year were insane. And you were like, holy cow, how can this continue? And then we do it again, and maybe not at the same pace, but at some point you've got to have a slowdown. And things have slowed down, but you're still seeing enough competition out there in the market, enough demand out there in the market to drive prices up. And yeah, I would say it's surprising.
All right. I wanted to throw this in here, Jeb. This comes from Calculated Risk, just to say, we just showed you nationwide, 6.5%, 7% year over year. Here's 30 markets around the country that have had dips of some sort. Austin's the big one that everyone talks about, 12%. Coeur d'Alene down 5%. Boise down 4.5%. Those are the big ones. You hear a lot about San Francisco. You hear really San Francisco is the big one on here. And to me, they're down from the peak 3%. So essentially flat. Most of these markets, except for maybe the top 5 or 6 there, are really looking at flat. But it is important to note that these areas didn't see 5, 6, 7% year over year over the last 2 years. So it is essential that you know your market. Jeb, this one I did not throw in here just to make it look like lifesavers. You had said something, we record the podcast Wednesday mornings, and you had said something leading it off just of this is a really weird market to get a handle on of what to expect, what comes next. This is one day. We had a very data intensive day. So ADP jobs come out. They were expecting 175. It was at 192. It's not super hot, but I put it in there in red because it was hotter than the market expected. Should have seen a negative response. Market shakes it off. S&P Global Manufacturing PMI 49.9, 50.1, pretty much as expected. ISM Manufacturing PMI down a little bit. Those are, yellow. I put them in yellow, kind of just moderate, didn't do anything. JOLTS, job openings. We talk about how important the labor market is to the Fed right now. And we'll see that in their announcement. Expected at 8.69 million down to 8.488. That's one of the things that they want to see, less job openings. The big one here, ISM manufacturing prices paid, expected at 55, comes in at 60.9. That's a big jump. And that's something that can be indicative of future inflation. So it's not starred in gold there. That's not a big market mover, but definitely something there. And then you already hinted at the rate decision in the press conference. It was positive for the market. So positive on the day. But let's look at all the mixed signals that we're getting. Core personal consumption expenditures. We got that last Friday. We talk about this is the Fed's preferred measure, but the markets have been paying more attention to CPI. So this wasn't good for the market last week, but it didn't have a huge negative impact. But looking here, we've had people try and say, well, look at a 3-month average, look at a 6-month average, look at a 12-month average. They're all well above 2%. So we're under 3% on the 12-month, but trending in the wrong direction. You can see all of them have ticked up a little bit there. So that is the inflation measure. Jeb, I threw this in here because it's important to note while everyone whines and complains about how terrible inflation is, there are certain products that have not been impacted. We can see that in the EU, in Europe, cocaine prices over the last 10 years have remained stable, while purity is up 40%. So you're getting more pure cocaine. Better cocaine for the same price. So if this were included in our CPI or PCE figures, they would have to make a hedonic adjustment, just like your phone gets better every year, but it costs the same when you buy it. Same thing with cocaine. So there is good news for some of you out there. It doesn't impact me much, but some of you. Talking about job openings here, Jeb. So JOLTS down. That's good. It shows a slowing economy, not the overheating that the Fed's looking at. Hiring rate. So it's positive 3.5%, but down. You can see the downtrend, less hiring. Quits down. Less people are quitting their jobs. Less small businesses are planning on hiring. They're still planning on hiring. We got 15% of businesses, but we were at 1.30 to 35% of small businesses were hiring. But at the same time, no one's laying off. No one's quitting. No one's hiring at a great rate, but no one's laying off good employees either. So we're kind of have this stalemate in the jobs market. You already hinted Friday, we get the non-farm payroll. We get a little bit of a preview with it with ADP. I generally think ADP is more accurate. No idea what the BLS is doing with those payroll numbers that we get on Friday, because we get to see typically every month we get a big adjustment to the previous month or two, and then a crazy insane number that will then get adjusted the following month. So we'll see. That's our big one to look at on Friday. Here's the ADP data just in a bar chart. This isn't the prettiest chart, but you can see we're right here, 192,000 jobs I think were created per ADP in the last month. It's kind of about normal. It's not a super overheated, but it's also certainly not weak. That would tell us that, hey, people are having a hard time finding jobs. Although some of our experts we like to follow, Danielle DiMartino Booth, follows closely a lot of the very leading indicators on employment, and she thinks the second half of the year employment is going to fall apart. I don't know what her exact projection is on how high we go on unemployment rate, but she doesn't think this sub 4% is going to continue going on. This is the actual prepared statement that the Fed released. The only important thing here is the changes. So the big one here in the top block there, in recent months, there's been a lack of further progress toward the committee's 2% inflation objective. You just saw that in a chart. The committee judges the risk to achieving its employment inflation goals are moving into, so I actually think I was supposed to cross that out. Inflation goals are have moved toward better balance over the last year. And then the last big block of bold just says they're actually going to slow down their treasury sales, the runoff of their treasuries. So I think they reduced it, Jeb, $35 billion a month. And you go, well, there will be 35 billion less of supply in the treasury market. But as we've gone through, that's a third of $1 trillion over the course of a year. And our government's adding that in about a full $1 trillion every 100 days or so.
Yeah.
So I don't know how big of an impact. It's a positive, but it's not the positive that many would have hoped for if we weren't issuing so much debt. There's some selected comments in here from the press conference, his answers. And when you look at this, it kind of gives you a narrative of what happened. And to your point, Jeb, I look at this, it is dovish, but very mildly so. The best we can really say is it's not hawkish. He says, I do think policy is restrictive and weighing on demand. Saw evidence of that in the JOLTS report. Restrictive monetary policy is working with the supply side. Confidence in inflation moving back down is lower than before. The signal we're taking is it will take longer to get on a sustainable path to 2%. He did confirm, I do not see stagflation regarding growth or inflation. So on either side of that equation, since December, we've had higher goods and housing inflation than expected. It looks like substantial lags in when lower market rents will turn up in the data. And Jeb, we have good data on that. We don't really talk about that, but it does sort of transfer over to buyers. People are considering rent versus own, what that looks like. We have a ton of apartment supply coming on the market this year and next. So it should feed into that signal with, if not, decreased rents, at least not the bigger increases in seeing that year over year. So we will not take into account political events in our decisions. People always ask, it's an election year. They won't step in and get involved. I said, we're at peace that we will do what we think is right when we think it is right, not be dictated by the election. It is unlikely the next move will be a hike. To hike rates, we'd have to see evidence that policy is not sufficient to bring inflation down. Incoming inflation data will be at the very heart of the decision. A rise in unemployment would have to be meaningful for us to react. So we've seen, Jeb, in these charts, a little bit of a downturn in the jobs market, but it's still really strong. So what they're saying is cool. It's trended slightly in the right direction, but we don't really care. This, we just hinted again there at government spending. This is an important chart, and it looks like it got cut off, or it's getting cut off by our, whatchamacallit, our referral link at the bottom. But basically this shows that we have historically, back in the 80s, we have spent more of our GDP towards interest as a percent of gross domestic product. So this is early to mid 80s. The problem is the trend. It's shot up so far, so fast that something is going to have to change in terms of less spending, less borrowing, or lowering interest rates real quick before we can get there. I didn't draw Jeb's line here up at the top, but if you see the peak of that, Jeb and Peter Bookvar and I forget, we have another expert that chimed in this week, fully expect that the 10-year will revisit 5%. We've seen for the time being, 465 has put in a pretty strong ceiling. I think we ended at 462 today. So if that green line holds, we're in a good spot. What does that mean for interest rates? I only did Mortgage News Daily today because Optimal Blue is a day out of date. We had some improvement today. But you'll see here, very minor improvement, 30-year fix 7.4, FHA 6.88. But I highlighted the day change because a lot of people will see headlines tonight. Market likes Powell press conference and interest rates improve. Very, very minor improvement, but much better than minor worsening, right?
Absolutely. No, good stuff. All right. So Josh, let's talk a little bit about inventory. We mentioned inventory a moment ago. Let's take a second here. I'm trying to fix my screen and I cannot do it. Just this, I love the teleprompter, but I hate the teleprompter, Josh.
We need a giant prompter is what we need. We need one that's like a 17-inch instead of a 9. We're old. We need giant screens for everything.
That is very true. My eyes are getting worse. But Josh asked earlier about some data that we saw on Housing Wire with regards to inventory. So we see inventory is growing. And what that data shows is that you have states like Florida, states like Texas, which we've been talking about, kind of in that southern belt, the Sun Belt, if you will, that is accounting for a large majority of that increase in inventory nationwide. So while you see markets like Southern California, where we are, the Northeast, and they're saying, hey, we've even got some comments in here. We're seeing cash offers. We're seeing craziness out there in the market. We're not seeing the inventory. It's because the inventory that you see increasing on a national level is really being influenced by a couple of major markets out there, Texas being one, Florida being another. But Texas, for example, I think back to 2019, Josh, was it 2019? They made up about 10% of the inventory nationwide, their active inventory. Today, they make up 17%. So 17% of the inventory out there that's showing active is actually located in Texas. And it's not necessarily situated in Dallas. Dallas is one of those markets that's not seeing the full effects of that rise in inventory. Some of the other markets are. So you take that out and you can see how some of these areas are just, oversupplied with inventory. And you have people there going, dude, I don't know what you're talking about. There's so many homes to buy. Like, we're not seeing what you're talking about. Again, real estate is local, guys. So just make sure wherever you are in the country, you're looking at your local numbers. And more specifically, if you're in Texas, looking local, right? Not, honing it down to really neighborhoods and specifically where you want to be versus just a kind of a bird's eye view of a market, because things can change just based on those few factors alone. So again, we just like to point it out. Not everywhere is the same. But Josh, I wanted to transition a little bit into the second thing you said about the 10-year going back to 5%. So I kind of see the chart as we're at this threshold, kind of bumping up against, you would call it support. I'm calling it resistance because the chart's going the other way. But either way, I think the numbers are, once we hit that so many times, it's kind of moving sideways, kind of forming that pattern to get ready to kind of go higher is the way I learned in technical analysis, kind of studying it and stuff. And so I think what you're likely to have is some data that isn't supportive of, lower rates is going to come out. It could be as early as Friday with the jobs numbers, and you're going to see that break and probably move towards 5%. Now, I hope I'm wrong.
Well, Jeb, let me go counterpoint. I hope you're wrong too. I don't. It's almost, you see the Sunday morning news shows and people are paid to take different opinions. I don't have a strong opinion about this either way. Another point from the technical perspective is the longer time, the more time support or resistance holds, the more likely it is to hold the next time. But the flip side of it is when it does give way, there's usually a lot of energy that forces it through fairly quickly. Matt Graham, a guest that we had on the show in the fall, he had a market recap at the end of the day, and he said, here is my take of the way the market is positioned. It would take more negative information to push rates higher than it would for slightly better information to push rates lower. So risks asymmetrically to the low side versus the higher side, but that is no guarantee of what happens next. All of the things that Jeb said and that I said are true, and they tell you different potentials for how it plays out. So the data is going to tell us.
No, absolutely. And I'm actually trying to pull it up here, Josh. So if you want to answer a question here, I'm actually going to show the chart how I have it drawn, just because it's a little different than it looks a little bit different. That's all.
Okay.
And so
we're gonna answer a little interesting one, not super related to mortgage and real estate, but tangentially. SNN Media, our regular viewer here, says, recently I've been seeing lots of cars, more than 20, queuing up at BJ's gas station to get gas, but just across the street, the Wawa gas has a handful of cars, signs of stress in the economy. And then the follow-up, gas at BJ's is $3.44 and Wawa is $3.59. And us Californians chuckle that you would have such
I don't know what the hell a Wawa is,
gas.
but
Wawa's a nice,
awesome.
it's nice. It's like a regional fancy 7-Eleven type setup, and most of them have gas. So the thing is, you're talking a 15-cent difference, where we are just here in Huntington Beach. So California is crazy, and we can have bigger differences. You get some of these coastal communities that by the beach, they only have one gas station. I paid $4.99 this morning. If I had taken 10 minutes to go Costco further up the way, it would have been probably $4.80, $4.85, something like that. But you can drive closer down to the beach and pay $5.99, $6.99. Drive through Beverly Hills, you might pay $7.99. You're looking like, do these people not pay attention? But with everything, we saw the numbers yesterday from McDonald's, Jeb. The McDonald's is struggling, especially here in California with the minimum wage laws. Prices went way up. People go, hey, piss on this. I'll just go eat at home. And I think when gas is cheaper, when the economy is better, when other things aren't as expensive, you're like, do I really want to chase 15 cents a gallon? I mean, you're saying it's literally across the street, but you may say, am I willing to wait in line to get gas versus pull up to the pump to pay 15 cents a gallon? And it may, the size of your car may answer. If you got a 10-gallon tank, who cares? If you got a 40-gallon tank like I do, you probably want to save the 15 cents. But I don't know that there's anything bigger there other than, it probably is a sign of some stress in the economy and some change coming one way or the other.
All right, good stuff, Josh. So this, if I can do it, I mean, I struggle here with our chart. Is the way that I have it the way I have it drawn. Looks just a little bit different, right? I got a lot of chart. I got a lot of lines on here, but you can kind of
And
ignore those.
the funny thing, Jeb, just for the people at home going, what in the world is Jeb doing with 57 crazy lines on there? This is a calm chart. If you look at a real professional trader's chart, there's 3 times as many lines as there are. So Jeb has a subdued chart for a professional.
Yeah,
trader.
and these are all of those levels are area of support or resistance, kind of going back, months, maybe even a couple of years. But what I focus on more is that upward channel. So we're still in that upward channel on the right hand side, and towards the upper part of that channel, we're kind of forming, an area that's moving sideways, right towards the upper end of that channel. And so what I see when I see that is, okay, we're bumping up against resistance and or support, depending on how you want to look at it. And if we come down and we're still in that upward channel. So the trend is still up. We know that for sure. It's just, are we going back to a new high, or to a previous high, or do we stop before? Really hard to say, and probably more than anybody cares about. But I thought it was worth just giving you an idea of what we're talking about when we're looking at it here. Just to
And
provide some context.
someone looking at the charts would say, well, between what Josh said and what Jeb said, Jeb is probably right. I'm looking at it projecting a reversal, and Jeb saying we have an up channel until we see something that would reverse it. Let's assume that it's going to continue going in the direction that it has.
Yeah, exactly. So from there, we're going to move on and start answering some questions. So Josh, we're going to talk to Vern real quick because Vern is here. Vern has called me, and Vern actually emailed me while we've been on the show. So I'm going to answer Vern's question directly without calling him. But Vern asked the question of, he's received an investor offer on his house, Josh, from an investor group. And he's asking how much he might lose by taking an offer from an investor. So his house isn't active on the market. So I would ask you the question: when you're getting an offer from an investor group, where does that investor need to buy that property in order for it to make sense for them?
So especially when it's sight unseen, when I just know, hey, here's the property, here's what I will get for a top of market property. I know what my exit is. So I know what my costs are to sell. I can guesstimate how long that project is going to take and what my carrying costs are. So let's just work our way back into it. Let's take 3% off the top because I have to pay at least the other side's realtor and closing costs. So I'm going to give you 97% of what I can resell it for. Then I have to estimate what condition does it take for me to get that into. So it can vary greatly by region. I know a guy that flips in not rural, but upstate Pennsylvania. He sells the houses for $80,000. It might have $10,000 or $12,000 of renovation. When Jeb, you and I have looked at numbers here on a couple of properties we wanted to possibly buy in Huntington Beach, 130 to 250 for a middle of the road, 1,800 square foot, nice remodel, not like custom home. So when you say that, if it's $1 million home there, I got, call it 15%. So now I got 18% I got to take off the top. And I got to say, okay, what profit do I need and what cushion do I have to build in for uncertainty? So I'm going to say at a minimum, even here in Orange County, 25% less than what I'm comfortable reselling it for.
Yeah, and I would say that's high. Most investors looking to purchase properties are looking at the ARV, the after repaired value of that home, right? So once they get it, fix it up, and sell it, because these investors aren't in the business of buying a home to live in. Someone that is buying it to live in will pay more money and can pay more money because there's no profit margin that they need to build in. I will tell you, and in speaking with investors, because I have a flip opportunity right now that's on the market, it's on hold. Most of these investors want to pay anywhere between 60 to 65% of ARV. So when you're talking $1 million home, they're willing to give you $600,000 to $650,000 on that home. So in short, what I'm telling you, Vern, is you're shoot yourself in the foot by selling directly to an investor group without putting it on the market. Even if you put it on the market, those investors will pay more money because now they know there's competition. Now they know they're up against someone else. Now they know they need to do what needs to be done in order to get that property. I can tell you, speaking from experience with the other property that I have that's on the market, we came to market, off market. We had people willing to offer us $900,000, $950,000. We took it to market. Now we have offers well over $1 million for that same piece of property, right? So once you pay out commissions and everything, you're still ahead.
What did we say ARV on them was? 1,250,000 was a safe number.
At the
Maybe
time.
you get more
Yeah,
than that.
it's probably 1.3 now. Yeah, give or take. Yeah. So, but anyway, but Vern, hopefully it answers the question. I'll call you anyway, and we can chat about it in detail. One question asking about what time frame were those candles that we were looking at on the chart? They were not weekly. That was a daily chart that I was showing. Josh, I'm assuming yours was daily as well.
Yeah,
Yeah.
I like the weekly when we're looking for bigger long-term trends. So
Yep.
it would be awesome. Go back in yours, maybe not right now, but later, and flip it over to a weekly and see if it really tells us anything different. I don't think it will. It'll be pretty similar.
No, it still shows it's in an upward trend. Even more so, which is
Just sometimes
the
you will
part.
see what when you change time frames, if you see the same support and resistance levels, it tells you it's a more significant and serious support and resistance level.
There you go. Good stuff. We got Chris asking, what's the trend in the sales price for new home development, Josh? So I'm assuming the question is what are prices happening with new construction is the way I read that. Is that how you read it?
Yeah.
Okay. So, we don't have a lot of new construction where we are here in Southern California. Yeah, there's pockets. There are small communities being built, so on and so forth. But if you look at the numbers coming from Calculated Risk and some of these guys that follow the new construction market, religiously and in a lot more detail, the trend seems to be pretty much the same, right? Builders are building bigger homes, because they can maximize profit more. They're building, 3-story versus 2-story. They're trying to get as much square footage on a lot as physically possible because they can charge more money for that. But builders are still, my father-in-law was telling me that my brother-in-law and sister-in-law were looking at new construction here in Orange County, and they looked at a property, and I guess the next time they looked at it, it was 14% higher. 14%. In the same community, 14% higher. And I don't know what the time frame was in from when they looked to most recently, but it was a short time frame. So these builders are still maximizing price, and a lot of them are able to do it because they're also helping buy down the rate and doing some other funky things in order to make affordability appear better, if that makes sense.
Well, Lance over at Resi Club threw up, I don't know if you saw, it was very late in the day, Jeb. Lennar, 3-bedroom, 2-bath, 2.5-bath homes, 1,376 square feet. And I don't see the lot size in this article, but you have to see them. They literally look like 2-story single wides. And they are. They're literally 10 feet wide, something like that. They're very narrow homes on small lots. But you're seeing, we can't complain about that. What I was going to say in answer to this question is, it's very hard to look at new home builders and say, what's the trend with prices? Because they can do so much to manipulate the price while maintaining the profitability. This here in San Antonio, Texas, smaller lots, 2-story, small homes. So they're maximizing their profit. They can also use lesser finishes. And so you can look and say the median price came way down, but what the person is getting for that, those hedonic adjustments that we talked about earlier, sort of wash it out. What I can say is we just finished the first quarter. All the publicly held home builders had to do their earnings calls, and they are all quite bullish. They're not saying, hey, this isn't the best of times like 2021 was, but they're pretty happy with where they're at.
All right, good stuff. So if you've been listening so far, you found any value, do us a favor, hit the thumbs up. If you're not subscribed to the channel, I would appreciate you do that. Josh and I, if you're not familiar with the show, we actually take this live, post it every single week on our podcast, in addition to another episode where we dive into a fundamental of the housing market. Could be anything from, Mortgage 101 to something happening with real estate, how to make your offers better, really cover everything in a 30-minute deep dive just about that subject versus what you're hearing here, where we're kind of bouncing all over the place. That said, if you haven't listened to The Educated Home Buyer, go check it out. We've got E-Ra. I couldn't see. I think it's E-Ra something on here. Normally listens on Spotify. First time making to a live. So appreciate you coming and checking out the show. I know you put a question in there. Hopefully provide, we were able to provide a little value to you. But if you're not listening to the podcast, do that. And if you haven't gone over there and subscribed, we would appreciate that. And the last thing is, if you want to work with Josh, our team here, to get a mortgage, you're looking to buy real estate, there's a referral link in the description below where we can actually guide you through the process. You can work directly with us, and we would love that opportunity to help guide you. So, Josh, we've got Parmond. Pomond.
Parmod.
I am closing tomorrow in Maryland. Single family, $800,000 home on 0.4 acre lot. I'm doing 10% down payment and getting a rate of 7.25%, 30-year fix. What would be a good rate to refinance and when?
So we're going to go back to our rule of thumb. First off, congratulations on becoming a homeowner, getting a good rate, and getting an awesome 0.4 acre lot. Those of us here in landlocked Huntington Beach are envious of your large lot size. But 125,000 divided by your loan amount will tell you how much you need to save in rate to make it worth considering. So
720. Yep.
Yeah. So 125 against 720 gives us 0.1375. So a little more than an eighth. I would say there's work, effort, and energy that goes into refinancing. So you're probably going to want to save at least 0.25%. People always ask, what's the magic? Why is there magic in that number? There's not. But when we run it, it generally gives you a savings large enough on a monthly basis that someone is willing to go through the effort and energy of refinancing. I had this conversation earlier today with a listener that we're getting pre-approved to buy here in San Diego. His loan amount is going to be somewhere $850. So just a little bit bigger than this. And we ran through it and say, you can justify it at a quarter. I would probably want to wait to see 3/8 or a half, just because once we get a trend, rates are so high right now that it's reasonable to think you would have a 0.5% drop if you get a 0.25% drop. So you don't want to do this over and over again, even though you can do it no cost. You just time, effort, energy. And then when you consider, we've talked about early payoff penalties that your lender pays, they would like you to stay in that loan for 6 months. So you don't want to really be out of the market if rates continue dropping lower. So anywhere from an eighth to a quarter would be the minimum. I'd like to see 3/8 or a half for someone in your situation.
Good stuff. Drew is asking, did anybody think about considering the fact that the baby boomers are going to start downsizing and bigger homes are going to be more available? Massive retirement. And then we have a follow-up from a listener, Big G, just coming through and saying there was an article in the Wall Street Journal that boomers are not downsizing, they are staying put. So I can speak to that, Josh. Got clients that are older. The problem with many boomers out there is that it costs them more money to downsize than it does to stay put. And if that house that they live in has the opportunity for them to stay there, has a downstairs bedroom, whatever, most are choosing to stay there because, again, to move, they're paying not only moving costs, selling fees, all of that stuff, but they're paying more money than they probably would like to downsize to a smaller property. And when somebody's lived in a larger property their entire life, I hear the rebuttal from people even considering moving, and they just don't want to deal with it. And so you've got a lot of people staying put because of cost, because of, it just doesn't make sense financially for them to take that on. And I think you're going to see, as time goes on, the next 5 years, you're going to see more boomers selling. But it's not going to be this avalanche where everybody decides one day that they're going to sell and it's all going to happen in one market and it's going to collapse prices. What's going to happen is you're going to continue to see a slow trickle to the market of boomer property, probably for the next 10 plus years. And, some markets might have a little bit more. I told Josh this, Palm Springs. Palm Springs is a market when boomers start selling and dying off, whenever that is. It sounds like a really morbid thing, but that is a market that I could see get hit, right? Because there's a big older demographic. It's concentrated. Palm Springs is a pretty concentrated market, although there are pockets there in different cities, that sort of thing. The Villages in Florida, right? One of those markets that has a lot of boomers. They all, start, I don't like saying dying off, but they start passing away. That can have an effect on pricing. But outside of markets that are concentrated like that, I don't think you're going to have that issue. Josh, what are your thoughts?
Jeb,
we've done an episode on this. Yeah.
This is what I was going to say. So I don't say this to beat up on Drew. Drew's here every week, asks good questions, thinks good thoughts. But did anybody think about considering the fact? It reminds me a lot of the questions that we get. We'll do a 30-minute episode. Someone will see the title of it, won't watch the video, won't listen to the episode, and then we'll continue to explain to us what's going on based off of one headline or article that they also didn't read. So we did the episode on this. We did the research. There's a lot of really good research on it. It is a factor. It's vastly overstated, and it will be far towards the end of the decade. So Drew did follow up with be patient, my friends. I agreed. I think it will be more towards the end of the decade, and it will have an impact, but be a subdued impact. Some of that data, a lot of that data shows that a lot of these homes are bigger homes in nicer areas. So they're not really the inventory that we're hoping for. We're talking about the builders are responding by smaller lots, smaller houses, cramming everything in to hit price points for first-time buyers. A lot of this inventory is going to be in nicer, more upscale areas because these folks have aged through. So just, I say this in the nicest way, and not to pat Jeb or myself on the back. Jeb talked last week. We spend over $3,000 a year on data. So not just free stuff, not just the crazy clickbait headlines that you see, the lunatic on CNBC that they brought in because they know that segment will get views because they tell you there's a silver tsunami, or better yet, it's Meredith Whitney. She followed up, Jeb. I don't know if you saw this, but she said home prices are also going to crash because young men aren't having sex. That was her conclusion. Young men are not having sex, so home prices are going to crash. And I'm like, okay, well, maybe you haven't talked to any young women. I do a lot of loans for single women, or a woman with a marginally attached man that she says, I will buy the house. And if I have to kick him out, I will just go ahead and do that. So things are overblown. People are always trying to get attention, play an angle, but the data is out there. There was a comment on one of the YouTube videos this week. It's actually a short, Jeb. So the shorts are our episodes taken out of context. So I get it when someone replies with an answer, but they're saying, well, the data is really simple. It says this, this, and this. And you're like, well, clearly you watched a CNBC segment or read a Fortune pay-to-play article that told you that, because there's 50 actual pieces of data behind it to show that not to be the case. So there's probably nothing more misleading out there than the silver tsunami, but it's not a complete red herring. It is a real thing. It's just going to be much more muted than people think and take longer than people think.
Good stuff. Lynn, just telling us that she bought a house back in July, but still follows the show and appreciates us. So we appreciate you, Lynn. Thanks for tuning in and continuing to support. We are grateful for that. In fact, if you need to get in touch with Josh or myself, there's a referral link in the little tag here following the bottom of the video where you can reach out and have a conversation. So Josh, any thoughts? We get this all the time. Thoughts on this? Comments on a possible crackdown coming with Wall Street buying homes, facing a renter nation, and those investors being forced to liquidate their property. So, could you see a scenario where investors would be forced to liquidate?
The question made me chuckle, Jeb, because on one of the videos we did, there was a novel of a comment from a very sincere gentleman who actually signed his name to the comment, so that we didn't just have his username. We had his name at the end of it. So I say this with all honesty, very sincere, because it was a long and detailed answer. And his solution was, it's just simple. You just ban corporations from buying and the problem is solved, just clean as a whistle. We've gone through the data here. It is not an issue in 95% of the country. If you're in that 5% of the country, which are desirable markets, it is a problem and you are not happy about it. The poster child for it is Atlanta. There's more of this institutional buying or build and rent in the Atlanta area than just about any other market. That's Arizona, Texas. There are a handful of markets that are impacted by this. And if you're in that market and you're a first-time buyer, you're like, I'm 28, I just got married, we're having a kid, I need a house. You go, this is bullshit. So I get it. Totally understand the sentiment. Who's going to do it? California has proposed crazy legislation that it's not nearly narrow enough. I believe, I don't know what you think, Jeb, I believe you could craft some narrow legislation around this that would disincentivize massive scale buying of homes, because we talked about this. This question came up last week. There is a time and a place where we need corporate buyers to step in. That time was 2009, 2010, 2011. So it's the exact opposite right now. But if you tell them, hey, you can't do this, but be on standby when we do need you again at some point in the future, it's a tough one. So again, much like the silver tsunami, overstated. It's not a silver bullet. You can't just pass legislation to get it done. And I have as much faith in our politicians that if they passed something, it would be overly broad, overly restrictive, and have more unintended consequences than the positive that it would bring to those of you in the markets that are getting hit by it.
Agreed. And on top of that, understand that most corporations aren't going to sell property unless, again, they're forced to do so. And I can't see any policy that would work backwards and make, investors that already have property liquidate, right? I mean, these investors are getting fixed rates on appreciating property with growing rents. I mean, it's the best investment in the world, and they're, the corporate buyers, the ones that are publicly traded, are bringing their shareholders good revenue. There's no reason to ever get rid of these properties, especially in the market that we're in now. And if you stop them from being able to move forward, would it have an impact? Yeah, but less of an impact because supply is already at a minimum, right? You would need inventory to grow significantly and then not allow the investor buyers into the market in order to really have inventory grow at some substantial level. And if there were some distress sales and you didn't allow it, then that would be a bigger impact. But we're not there. In fact, if that does happen, we're years away from that, in my opinion. So for the time being, it's kind of one of those. It's a moot point.
Jeb, you want to know what's funny about this discussion to me is flipping in 2009, 2010, 2011. We had these institutional buyers coming in and were buying up a lot of homes, and they were rehabbing them and putting them out to rent. And our thought is, you don't want to hold any of your properties, because at some point these corporations are going to go, hey, we're up 25 or 30%. We don't make that big of a yield on the rents, and they're going to dump that supply back into the market. It's part of that shadow inventory conversation. All of these corporations hold all this inventory and they're going to dump it into the market. And not only did it never happen, they're just sitting on the massive portfolios that aren't up 25%, they're up 200% probably from when they originally bought. So we try and project going forward what's likely to happen. It is hard to say over the long haul.
This is a good question, Josh. Kyle saying, what are the biggest watch outs when buying flipped homes? An escrow on a home that looks well done, but small details like the fact they painted the roof to make it look newer makes me weary. Understood.
That's the right thought.
Yeah, I would say buying flipped homes, biggest hurdle, or the biggest thing that you should watch out for, in my opinion, is permits. Most flippers will not pull permits, which is okay. I will say it's not that it's okay. It's okay to me. If they didn't pull permits, as long as they're not doing structural work, right? As long as they're using a licensed contractor, to GC it, and there's no structural stuff, I care less about the permit side. But what we see out here is a lot of structural stuff. Walls have been removed, things like that, no permits pulled. That's something that you need to pay attention to, in my opinion. But you kind of mentioned it, details. Details are super, super important when it comes to a flipped home. Because what they want to do is draw your eyes in with the pretty countertops and the shaker cabinets, but you start paying attention to the baseboards and the flooring, how things don't meet up. That's a problem. Or seeing where they spent money and where they didn't, right? If they're not replacing the small stuff in the house, that's not really that expensive to do. If they're not going, on a higher end type of small item, then chances are everything they've done is cutting corners to some degree. So you'll find some flippers that do fantastic jobs. They spend, top dollar, but they're also looking to get top dollar out of properties. Whereas then you have some people that are just hacking properties to flip through to get them done
and still want top dollar.
Right? And so somebody painting a roof, I can't speak to that property, but that to me would be somewhat of a red flag.
No, 1,000%. The things I was going to say, Jeb, you covered it perfectly. The big picture, what I would say, if you see them cutting corners visually, just run. I'm sure there is a crook flipper out there somewhere that is good enough that they can cut corners on the things that you cannot see and do a great job with the things that you do see. But they're one in a million. If they cut corners behind the walls, they cut corners on the things that you can see. Look around and they'll go, well, they didn't quite do as good a job on the tile as I would hope, or I could do that tile better than they can, but at least it's a pretty tile. If you are seeing any alarm bells, any red flags, just run. It's worse than what you think.
Good stuff. All right.
Jeb, we have one we have to get to because he asked very nicely, and it's actually a really good question.
Let's hear it.
Luis, longtime viewer, in New Jersey, buying a house with FHA, getting a $17,000 grant, but I cannot refinance for the next 5 years. If I do, I have to pay back the $17K. If I go conventional, I can refinance anytime. What do you recommend, Mr. Jeb?
What rate are you getting? I mean,
Let's just say in general, FHA is a 0.5% lower than conventional.
yep.
Depending on your credit score, it can have significantly lower mortgage insurance or similar mortgage insurance. But
Yeah,
anyway, you cut it. It's
and
rare that I have an FHA buyer or a buyer that qualifies for both that the FHA isn't a lower payment.
I again, and I would say, is the grant a true grant, or is it something that has to be paid back after 5 years, even if you don't refinance? I'm assuming it doesn't, based on the way you wrote it. But I would be hesitant to take the FHA with the $17,000 grant and not be able to refinance versus doing the conventional. I would prefer to go to conventional personally. But again, I'm just looking at this face value without any numbers and not comparing anything. What are your thoughts, Josh? I know you have an opinion here.
I think that it's worth it going with the FHA because they're not telling you can't refinance. You would just have to pay it back. So what are we doing with it? $17,000. Also didn't mention the price point. Is that covering your down payment? If so, there's equity in the property there in theory that could be paid back. So New Jersey market is hot. Prices are still going up rather rapidly. So you're likely to have the appreciation, especially if interest rates are low enough where you can refinance. So you could refinance. You just have to give the $17,000 back. So if it's the right loan now, I wouldn't hesitate or be against it. Because again, for most people, other than husband and wife, 2 borrowers, 800 credit scores both, you're paying a premium to that conventional versus FHA that I'm just not willing to do. I shouldn't say that because depending on where you are, if you're home ready or home possible eligible, which means 80% or less the area median income, conventional is much more attractive. At 100% or less the area median income, loan level price adjustments go away. So again, can also be very attractive. I would hope that your loan officer has done the side-by-side. I would probably lean towards doing the FHA, especially if, as Jeb said, in 5 years it goes away. But I wouldn't look at it as saying I cannot refinance. It's saying there's a little bit of a penalty to refinance, and I want to make sure there's a really big benefit. You know, if rates go from 7 to 5.5, probably plenty enough benefit on a decent sized loan. There is not a right answer to this question. It's compare the numbers, think it through, and go with your gut.
I just feel like he would have a very hard time mentally going and saying, okay, the numbers allow me to refinance, but I got to pay 17 grand back. I'm not willing to do that. And therefore being kind of stuck in that FHA. If again, there's not a right or wrong answer. It's just how you're viewing it and what that 17 grand means to you. If you need that 17K, then that's the easy option, right? That's the easy answer. If you have money outside of the grant, then it might make sense just to go conventional and not worry about it. But again, look at the side-by-side and go with what you're comfortable. Just go with your gut. I mean, that's really what it is. It's not a decision Josh and I can make for you. Here's another one, Josh, around down payment. It says, is it better to put 15% down as a down payment or put 5% down and pay the remaining 10% down together with your mortgage payment? June mortgage payment will include 10%. So is there any benefit? There's this belief out there, again, Josh, that you can hack by paying different ways.
And we're going to do an episode on it.
We're actually doing an episode on this. But this is one of those house hacking beliefs that you can somehow cut the interest down significantly by paying some large sum down on one payment. So just kind of address the question there.
So 2 pieces to it. You're going to be paying more mortgage insurance because 15% down is going to have very minimal mortgage insurance, 5% more substantial mortgage insurance. So there, you're in a worse position. How does the additional 10% with the first payment help? Well, the 5% down set your principal and interest payment up here. You just made a large principal reduction. So now there's going to be less interest every month, and the next 359 payments, more of it is going to principal. You didn't help yourself. You just locked yourself into a higher payment. It helped you in terms of it will pay it off sooner by locking yourself into that higher payment, but do the 15% down, get the lower mortgage insurance, take the mortgage insurance monthly savings and whatever else you are comfortable every month, put it into additional monthly principal payments and shorten your term that way. There's calculators on the line online that can walk you through that. Jeb, we actually had a listener to the show reach out just this week that during the pandemic, they thought they were doing a great thing. They did a 15-year mortgage, 2.25%. They're like, this is awesome. In 15 years, we're going to have the thing paid for. Well, job career plans didn't quite go as expected. And now if they had the 30-year at 2.875, no problem with the payment, but they're looking at refinancing and consolidating some debt to make it make sense. So I'm just very hesitant to lock yourself into a higher payment than you have to. And that's the only benefit here of how that would work.
Got it. I agree 100%. Taylor has a question, something we've actually done. We've actually done an episode on Dave Ramsey. Haven't we, Josh? I know I've done a
Yes.
video on it. We did
We did
one
the
as
whole
well. Yeah,
episode on it.
I
Yeah.
thought so. So one of the things that Dave recommends is not buying a house unless you have 20% down. But also when financing it, making sure you can do a 15-year fixed rate at the same time. So I don't agree with that. I don't think. Is it ideal? Fantastic. Yes. Yeah, that would be ideal. If everybody could do that, that is the way to do it. The reality is, look at the median home price in Orange County and Huntington Beach, where we are, 1.2 or so million. So you need $240,000 to be able to buy the house, and you got to finance it on a 15-year rate at 7+%. Your payment's going to be like $13,000 a month. I mean, it's not real for most people. Where he is in Tennessee, Eastern Tennessee or whatever. I mean, you can buy a house for a third of what you can out here. And maybe if you're making the same money you would make in California, it makes sense. But for most people, it's not. I would say go with the 30-year fixed rate. If you can pay it like it's a 15-year fixed, just get an amortization schedule, figure out what the 15-year fixed payment would be, and pay it like that. And then that way, if at some point in the future you can't pay it, you've always got the backup to go back to a 30-year if you need to without refinancing. But that's the simple answer. But I would say go check out that episode. I don't know what number it is, but we can look it up and tell you.
Absolutely. Check out that episode. One of the things I would say about Dave's advice, any piece of it in isolation is not a bad idea. When you combine all of them, they get so restrictive that it is very hard to follow it. He's putting such guardrails around you that you cannot fail. But by putting those guardrails, you also can't drive at a normal rate of speed.
In fact, you can't drive at all because he won't allow you to have a car.
He doesn't give you the keys. You're sitting in the car.
You can't have a car with him. You've got to ride your bike.
Jeb,
but no, I mean, Dave's, again, let me just follow it. Dave's advice is fantastic advice, but it is dummy proof because he does believe that most people are idiots with finances, and he's not wrong. But the reality is, if you want to become a homeowner, it's not realistic in this market for most people. So
the less disciplined and together you are put together with your finances, the more you need Dave's advice. So use that for the sliding scale of how much you should pay attention to.
So here's one, Josh. Are you going? Did you already pick one?
Yeah, I just wanted to throw this up here. It's a comment, but there's several things in here. Interest rates will go up, in my opinion. So Jeb and I just had a little debate back and forth. Neither of us feel like they're going down appreciably in the near term future. So very valid opinion, and you need to go with your gut. You make your own decisions, right? I watch a lot of housing YouTubers. Be very careful.
I'm sorry.
Real Estate Mindset says inventory is shooting up in Texas. Do not concern yourself with what anyone says. Have them show you the data. We had Lance Lambert on 2 weeks ago. He has the best data on every market. He has free articles that will show you exactly what's happening in Texas. This just leads me to believe that you're flipping around watching videos. There are many people, including the one that you mentioned, that just straight up lie. They use data to lie.
The reality is he's not a very smart guy.
No,
he's not. And it's not a dig on him. It's the reality he's not. Listen to his videos. He has no idea what he's talking about. And look at how long he's been making crash videos. He's doing it to get clicks. The reality is I don't think he truly understands the market to begin with, but he's doing it to get clicks, and it's working for him. But he's had the wrong message for the better part of 2 years, and he's going to continue to be wrong, and it's that simple. So
the last piece there, Jeb, is Jonathan says, I move a lot and can't risk property values dropping. That more so than your belief on opinions. That is the best reason to not buy a house.
Agreed. Unless you can turn it into a rental.
If you need that flexibility and optionality and can't have a 5, 7, 10-year time frame, absolutely rent. And Jeb, we probably at some point in the future should do an episode again. I think we already did it once. If you are not going to buy, what do you have to do to make sure you get where you need to go? Because it sounds like buying is not right for you. It doesn't feel right to you. Do not buy a house, but how do you get ahead financially without that sort of key element of your financial
Bitcoin? Life? Duh, bro. Come on. I mean, duh. You buy bots that trade for you, Josh, and that's what you do.
Hey, my bots lost me $1,500 last week. Be careful. You're poking the bear, and I don't appreciate it.
And I was kidding about Bitcoin. Question. So Josh, they're trying to get you riled up here, bro. Says, can you help settle this debate? Student loan forgiveness and grants for home purchases are both funded by the government and therefore increasing government spending. Is that correct? So Josh, how do these things get paid? Does
The
money just
student
appear?
loan forgiveness is 100%, taxing 99% of people to advantage and benefit one group. And that group is not just people with degrees, because many of those people paid for their own way, paid off their student loans. So for what it is, it's a simple answer. Yes, it adds to the debt. Now, the grants for home purchases would be interesting. Like here in California, like the way everything works, there's bonds that are sold. They're kind of revenue neutral. I'm not an expert on this. So if someone has information that says, Josh, you're an idiot, and it absolutely adds to the state tax bill, we'll see. But look at something like California Dream for All, 20% down payments. What is it? Is it 300 million, Jeb, is their funding for this year? At some point, they're going to get that back with interest. In the short run, that's spending, but it is an investment. That state of California is making a $300 million investment in their citizens owning homes and the housing market of the state continuing to appreciate going forward.
Agreed. Your wife just sent us a text, and that lot that I sold a couple years ago is finally getting built on.
No way.
Oh, like, dude, it's a monster of a house. You have to check that out. Anyway,
why don't you share the picture with everyone?
Because it's on my phone, and then I got to get it to my computer.
I'm gonna get it. I will get it to share. You find our next question. Did you send it to both of us?
Yeah. What will happen? Listen, Parmad. Sorry. What will happen when interest rates drop? Are home prices still going to rise, or there will be some inventory catch up by then to meet the demand? So, good question. It really depends on how long are interest rates going to take to drop, right? If it's 2 years, inventory is probably going to catch up a little bit. If it's 6 months, I don't know the inventory. Yeah, inventory is going to grow, but at some point, it's kind of what we saw last year in October, November, when we saw the peak at 8%. We saw the housing market just kind of stall because less people were willing to even entertain the idea of selling at that point, because of and most sellers are buyers. They have to go buy something else, and they looked at it and go, we're not doing that. So the market kind of stalls a little bit. But I do think as interest rates come down, it's going to allow some more demand in the market. The whole thing about prices continuing to rise, I struggle with to some degree, because affordability is still going to be a problem. And I think we're at that inflection point, Josh, where home prices cannot continue 5-6% appreciation year over year continuously without some sort of sideways to pull back that we have not seen. And so what's going to cause that? I don't know. I just have a hard time seeing, like we said at the beginning of the show, these, year over year increases without some pullback to that long-term trend, and just kind of a feeling more so than anything else. But that's it.
I don't think you're wrong, but I don't think you're right. If I were a betting man, you have to see it moderate. 6 to 7% can't continue indefinitely. So does it moderate to 0%? Does it moderate to down 3% for 3, 4, 5 years? Like what we say, San Francisco is down 2.9% from the peak. If you saw 2.5% for 3, 4, 5 years, that's a 12% reduction. If rates drop from 7 to 5 in the same time, because that reduction, it's a low point in the economy. At the same time, those that have jobs, wages are going up. It brings the affordability not back in line to where it was, but with where that long trend of decreasing affordability, but we just spiked to ridiculous levels of unaffordability. So I don't know. I've seen enough in terms of the strength of this market that I just don't see for the dense populous areas with vibrant economies how it happens. But
I'm calling 2027 to 2030 is when you see home prices moderate. That's a couple years out.
Well, Jeb, I've got my book here. Why am I drawing a blank on it? It's The Secret Life of Real Estate and Banking. You can't get it on Kindle. The guy charges like $60 for it. And he has a very developed theory going back 250 years or so about real estate cycles. And he believes, I believe 2027, we're going to see a real estate crash. Very different than the crash bros that you'll be seeing online.
I don't know if it's a crash. I'm saying you see a moderation in the market. Again, and that would be 100-year cycle on the Great Depression, which, if you're a conspiracy cyclist, whatever, I kind of threw two words together and made a conspiracy cyclist. But if you're,
they ride a conspiracy bike around
theorist that, you believe in cycles, then, who knows, but no crash coming anytime soon.
Tell our friends what this tells us about the housing market right here.
So guys, let me tell you, I sold this lot. It was a vacant lot. It's in a flood zone A. If that means nothing to you, it means it's essentially unbuildable. The city of Huntington Beach would not allow any building on this lot because of it's below flood zone. I mean, it's below the flood level. It's a couple feet below the ocean, which is a mile. What do you say? A mile as the crow flies from there, Josh?
From that house? Yeah. From my house, it's about a half mile, and my doorstep is a foot below sea level.
Yeah. So, but that's a easily $1.5 million build right there. They paid $850 or so for that lot, if I remember correctly. It's, yeah, I mean, there's construction like that going up everywhere in Huntington, and remodels and everything else. It just shows you, still a lot of people out there with money. And in fact, today's episode that we recorded, which will drop next Tuesday, we talk about what we're seeing in the market. Talk about what I'm seeing as a real estate agent. Josh talks about what he's seeing as a mortgage professional. Kind of an off the cuff episode, more of a conversation than it is going through a time, a bullet point, outline, if you will. It's a good conversation. If you're a buyer, if you're a seller out there in the market, something to pay attention to. You'll catch it next week on Tuesday. This will be posted on Friday. If you want to get connected with Josh or myself, there's a referral link in the description below. If you found any value, hit the thumbs up, subscribe to the channel, and Josh, we'll leave you with parting words this evening.
I love our regulars here. Burn It Up proves that you guys actually do pay attention when we're talking, because he comes back with a detail that I forgot we'd ever even talked about. Burn It Up says
I just cut you out, bro. I cut you out. That's fantastic. Hey,
what are you doing over here? Stop taking me out.
You keep talking, dude. I'm just going to cut you out, bro. I don't know what's going on. I can't.
He says, "Was this the home that knocked? Was this the one that knocked down the home and did not leave a wall?" And that's exactly what it is.
That is.
Had
that
they
is
left
it.
A wall, the city will permit a remodel to a home in flood zone A.
But the understanding or the rumor is that they didn't knock down the wall, that a neighbor came in and knocked down the wall, and because there was one wall left, because they didn't want them to rebuild, and that's what prompted the city to say, nope, now it's a full rebuild. I don't know if that's true. That's what I was told kind of through the grapevine. That lot was sold. I sold that lot 5 years ago, Josh, probably more so. No, before that, 6 or 7 years ago. And It's been that long since they've been able to build on it.
Yeah. I wanted that lot really bad. I was not willing to deal with 4, 5, 6 years of figuring out. And it'll be interesting. We'll post the pictures when this gets done. My understanding in flood zone A, that thing's got to be up. It's not on stilts, but it's up a foot or two for that.
I was told it had to be built on stilts at the time. I have pictures of that lot. I'll have them for next week. We'll pull it up and show what it looks like.
And then again, before I say the final words, Jonathan came back, says he wasn't trying to trigger anyone. My apologies. No apologies. What I wanted to throw up there was to make a couple points. Your belief about where interest rates are going are as valid as anyone's. Your knowledge of yourself that you're not going to be somewhere long enough to make buying make sense right now is valid. And probably most importantly, do not let anyone tell you anything. If they believe something, they should show the data and point you to it where you can read and research and confirm whether you believe it or not.
There you go. If you're in the market, focus on what you can control. Don't get caught up in YouTubers and everything else. Don't, follow anybody's advice verbatim. Make your own decisions, but do it data dependent. Know what's going on in your market, and just make the best decision for yourself. So we'll catch you next week, next Wednesday at 5 p.m. Josh, until then, what do we like to say? Adios.
Amigos.